All right, welcome to the webinar. Today we're going to be covering the stock warning signs, which are a proprietary indicator on the GuruFocus website. We'll be covering a few other things as well before the end of the presentation. But the main purpose is to go through how you can use these warning signs to assist you in your own personal investing. So, when it comes to the GuruFocus warning signs, as I said, these are proprietary formulas developed in-house, applied to individual securities. And what these are looking for are fundamental issues. So we're talking about deep value-based stock metrics, declining, and trending away from those more favorable value metrics, right? And these have kind of been proven historically to lead to declining share prices. So we look at what happened to other companies in the past that have suffered poor performance and try to prevent ourselves from owning securities going through some of the same things. Now within the site there are 32 different warning signs. These cover the financial strength, profitability, growth, and valuation of securities. There are also two classifications of warning signs. There are medium and severe warnings. This is going to depend on the severity of the underlying metrics and how far they've moved. And then, like everything on GuruFocus, it's very, very clickable. So any warning you see, you can click on, go to an analysis page, get full details on that warning, what's going on with the company, to give you a better understanding of how that works. Now here's a complete list of those warning signs. Some have been combined. You can also find these in Charlie Tian's new book, Invest Like a Guru. This is chapter 6, I believe. That goes through the various warning signs you want to look out for as a value investor. The financial strength of the company, profitability rank, revenue and earnings growth, operating losses, margin growth, both net and operating margins. If asset growth is greater than revenue growth, this can often be a sign of something to look out for. Days sales outstanding, days sales of inventory. We also look at the deviations between owner and reported earnings. Now, Warren Buffett was famous for developing this sort of basic formula for owner earnings, as if you own the entire company, what would you walk away with? And it's a different figure than the net income or reported earnings we see once a quarter, where it's, XYZ Corp did $1.38 a share. Now, if over time there is a large deviation between these, that's something you want to be cautious of. The same thing is true for net income versus free cash flow. If there are large divergences between these two, not a 1 quarter or 1 year issue, but a sustained divergence between these two figures, we're going to let you know about that. If the cost of capital is greater than return on capital, right, that's a problem. If you got to pay 5% to borrow money and you only use it to earn 4%, you can't stay in business doing that. Issuing debt or new shares of stock. Debt is going to obviously increase their interest coverage, their interest payments or interest expense. New shares are going to dilute current shareholders. So we're going to keep you up to speed on that. The Altman, Petrosky, and Benes scores, the Sloan Ratio, interest coverage. In other words, how many times can this company afford to pay its interest? How much of its revenue or income is used to cover its loans? The dividend payout ratio. A company that's using 20% of its income or net income to pay that dividend is considered a fairly safe dividend. A company that's requiring 80 or 90% or greater than 100% of that net income, that's not very safe, and it could be a dividend that is soon cut. The short percentage of float. What this refers to is what percentage of the total outstanding shares of this company are currently held short. What that's going to let you know is how many people are betting against this company. The dividend yield, fairly self-explanatory. The stock price relative to its history. So if it's making 5-year lows, 10-year lows, something like that. where it's PE ratio, its price to book ratio, its price to sales ratio. We're looking at those versus a company's history. Okay, so it's not just we're going to give you an alert anytime the PE is over 20. If you look at a company like General Motors that's trading for 4, 5, 6 times earnings versus a Google that trades for 25 to maybe 40 times earnings, they're very different ways you have to evaluate those companies. So we're looking at each of the ratios based on the company's history and where it typically trades to let you know if it's moving outside of those historical ranges. Higher forward should be PE. The buyback track record of the company, what kind of history do they have of buying back shares, increasing shareholder value in that way. The insider selling transactions, so if you see the CEO, the CFO, a couple of board members all dumping shares, large amounts of shares at the same time, that's something you want to be warned of. And the tax rates, there's large changes to that as well. Now, there are also some good signs, okay, and we wanted to not make this too one-sided on the negative, but we will alert you to good signs with a company that reflect improvement in these value metrics. So we look at the same 4 fundamentals, right? The financial strength, the profitability of that company, its growth, its valuation metrics. We're looking for positives. So, for instance, if the price-to-book ratio is near its historic low, or it's a consistently growing revenue, price-to-sales ratio. If you look at like a retail stock, take Best Buy, or Amazon's a great example. That's a stock that's typically traded between about 2 to 3 times sales. I think the median line is right about 2 times sales. So let's say it stays between 2 and 3. All of a sudden that price sales ratio is at 2 or just under 2. That's going to be a good sign for you. You know you're getting in fairly cheap. And then obviously margins improving is always a good sign for a company. It can often represent a moat the company has, the ability to maintain or increase margins while increasing sales. Deteriorating margins obviously would be a negative sign on the other side. So let's go to the GuruFocus website. We'll take a look at how these look when you are evaluating stocks and kind of see how to navigate through these. So this is the GuruFocus homepage. Now to access these warning signs, obviously it's not a section dedicated to them. They're going to pop up on each individual security that you're evaluating. So let's take a look at Home Depot, for instance. And we'll just go to the summary page. And you'll notice that we see any good, medium, or severe warning signs just below the price of that security. Okay, so in our case, right here, we've got 5 medium warning signs, and we have 2 good signs. Okay, and of course, as we mentioned before, all these are clickable. So all we're going to have to do is to click on the title of these, and it'll bring us to a summary of those warning signs. So here are good signs at first. One, the operating margin percentage is expanding. Okay, so that's generally a good sign, right? They're making more profits on every dollar they bring in. So this is a positive. It's going to reflect a company's ability to increase earnings even if revenue were to stay still. If revenue were increasing, earnings should grow at an even faster rate. It's a good sign for the fundamentals of a company. The other good sign, the dividend yield is close to its 5-year high. So, if you want to own Home Depot and say a dividend aristocrat type portfolio, great time to buy it when the stock's cheap, meaning representing a dividend yield near one of its higher rates. Guys, give me 1 second. I hear someone has their microphone on here. Okay. Sorry about that, everybody. So, as I mentioned, dividend yield being a good sign there. Now, there's also 5 medium warning signs. So no severe signs with this, which is good. Nothing that's really a huge red flag. 5 things here. One, price is close to its 10-year high. That's not necessarily a terrible thing. It's not a totally cheap stock, but it's near its highs. PE ratio is close to its 10-year high. It's not going to be surprising, right? The whole market is near its 10-year high. Same thing with the price to book and the price to sales. So these are medium severity warning signs, right? You're not getting the stock for rock bottom prices. You're not getting it at super low valuations compared to its history. But it's kind of to be expected in today's market, given where valuations stand, that a lot of these fundamental metrics are going to be near their 10-year highs. And then also the issue new debt. Okay, so you may want to dig into that and say, well, you know, interest rates are rising. They wanted to secure a line of credit or some cash flow. All rates are cheap, and they can generate higher returns on that. So it may not be a big issue, but it is something we want to let you see. Now, as I mentioned, each of these is clickable for more details. So you'll see a little details button over here on the right side, and when you click on that, there's a more details option. And it's going to give you a full summary of this warning sign and what it means for you. This is a price one. Let's go back. So here's the PE ratio close to 10-year high. You'll notice the details here. It's showing us a 10-year history of the PE ratio right across the top. So we see we're right around, we're actually lower than we've been since 14, but near the high of the 10-year range. Gives you a basic explanation, the formula for this, a brief description about what you're looking at. All right, now most of us understand PE ratio, but for some of the more complex warning signs, this may be helpful to you. And there is a more details button at the bottom, and that's going to bring us here that goes through a more technical explanation of this warning. So you got a few things going for you. One is you've got let's see, I guess 30-year chart of this company with the PE ratio highlighted across it. So you can see kind of a trend line of where the PE ratio has been historically. You're getting a breakdown of how this was calculated, precise figures used to calculate it, and even the formula that we apply on the back end to generate these warnings. You're also getting a competitive comparison here on the right. So you're seeing the company's largest competitors or primary competitors and where they stand in relation to our stock. So we're the Home Depot green here. Now the larger circle means a larger market cap, and the smaller circle means a smaller market cap. So this is Home Depot, this is Lowe's. Then when you look at Lumber Liquidators and Haverty and some of these others are obviously smaller companies. But the vertical up and down is PE ratio. And you'll see we're pretty much right there in the middle, right around 25, 23.5 in this case, just below Lowe's, well below Tile Shop, but higher than some of these others on the zero line. And below that, we've got, again, a more technical definition here, kind of what goes into the back end of these formulas. We have a more in-depth explanation, some tips and history on this figure and why we feel it's important. And then, obviously, the historical data, both annually and quarterly, for that metric. So a lot of information here, probably more than you'll ever need, which is always our goal. But you could come across a warning sign you don't understand, and that's going to be much more helpful than it is in, say, the issue of PE ratio. So let's look at another. Let's look at, what's a crappy company? BlackBerry. Let's look at a bad one, see if we can find a stock with a lot of warnings. So, okay, here's BlackBerry, and somehow it does have one good sign, but also has 2 severe warning signs and 2 medium warning signs. All right? So we'll take a look at these and see what we've got. Now we'll start with the severe warning signs. 1, the Sloan Ratio. This reflects the quality of a company's earnings. Okay, and this is not a great sign for BlackBerry. Secondly, revenue per share decline. This is not surprising to most of us. This is a stock that was once $160. It's now maybe $8 or $10. I haven't personally seen a BlackBerry phone in years, and we're not surprised revenue is declining here. They do have comfortable interest coverage, so one thing someone said to me once before is you can't go bankrupt if you have no debt, right? So if you look at all the big stocks that have gone, companies that have gone bankrupt, the stocks went to zero, it's because they had these huge debt loads they eventually couldn't pay. So interest coverage always going to be an important aspect for the safety of your investments. Medium warning signs, price is close to its 3-year high, and the price to sales ratio is near its 5-year high. But let's say you don't understand the Sloan ratio. I don't really get what this is. Let me see some more. Well, first thing, just like before, we're going to see a 10-year history of that Sloan ratio. Okay, you notice it is extremely low now, negative 52. You get a very basic 2-sentence explanation here. Earnings contain a lot of non-cash earnings, which are called accruals. The Sloan ratio is a way to identify firms with low non-cash and accrual-derived earnings relative to their cash flow. Okay, that helps a little, but we can dig even deeper. So here we get a real history. Richard Sloan with the University of Michigan is the one who first founded this in a 1996 paper. And we see that, well, when it's higher than 25 or lower than negative 25, earnings are more likely to be made up of accruals, and we are way above that at negative 52%. We see where it compares to the others. Notice all these other firms up here are nice around zero, just positive, and we're way down here at negative 50 with BlackBerry. And of course, the more in-depth definition, which includes our formulas and how this Sloan ratio is derived. Now, all these are obviously hosted in the definition section. So while you're here, if you scroll down the left side, any other terms are always available to you with full definitions here within the fundamental dictionary. Now, we've seen a couple of the warnings, obviously, here, but I want to go through the full list for you really quickly. If you have Charlie's book entitled Invest Like a Guru, great read, I highly recommend you pick up a copy. It starts on page 100 and I guess 104 is where all these warning signs are listed out. It's going to cover everything from financial strength and profitability rank, operating losses, asset growth faster than revenue growth, and gives you a very brief kind of 4 to 5 paragraph description on each one of these and why they're important. So if you want to dig deeper into the whole idea of these warnings, it's a good place to go about that. So any questions about the warning signs, how they work, what to look out for? Obviously, these are only available to premium members of GuruFocus. If you're a free member, you'll often type in a stock, see it has warnings, and you won't be able to see what they are. So it is a member feature. So Mitch asked, "What is an accrual?" So Mitch, an accrual is it's an accounting term, but it's basically kind of like adding together interest and other investments over a period of time, right? So what you're looking at is I don't know. It's kind of hard to it's kind of hard to explain off the cuff, but basically it's cash. It's not really cash. If that makes sense. So it's assets they're having that are not technically cash in the books. They're accrued assets. So yes, that is correct, Charmaine. So lower on the page there is a summary of these warning signs, and you'll see them right down here on the summary page. Notice here we've got 3 severe and 5 medium for Apple. We scroll down and immediately see what these are listed out for us. And clicking on them is going to take us to the same place it did before, where we get a rundown of each of the warning signs. So the gross, basically with Apple, we get gross margins declining, operating margins declining, assets are growing faster than revenue, and this is, most people are aware of these facts with Apple. And the medium warning signs, these tend to be more fundamental metric warnings, right? So, dividend yield being near its 2-year low, which is, they've only been paying dividends for 3 or 4 years. Price is close to its 10-year high. Obviously, everything is. Price to sale ratio is near its high, et cetera, et cetera. Okay, let's move along, because we also want to cover investor checklists. Now, these checklists are something very unique to GuruFocus.com, and it is a way, kind of a final test as you select a security that you want to invest in, right? You've done your homework, you've gone through the numbers, you've looked at the news, you kind of have an investment thesis of why you want to own it. And what a checklist is going to do is just force you to be sure you've checked all the right boxes, right? If you talk to airline pilots, they go through a pre-flight checklist every single time they fly, whether they've been flying for 5 months or for 30 years. And it's just the easiest way to be sure you never forget anything. So these checklists, obviously, they're a new feature. We have Guru checklists as well as customizable ones. And most of these are pre-written from proven strategies. So it's other investment gurus, fund managers, stock pickers that have kind of shared what they look for when choosing securities. Now, all these are going to be scored out of 5 to make it an even keel. So whether there are 6 questions on the checklist or there are 16 questions on the checklist, we're going to automatically adjust that point scale so you get a final score out of 5 based on your answers. This way, you can equally compare it with any other stock. And there's also space for some of your research notes. Now, this is where you'll find that when you go to any summary page. Way over there on the right side, you'll see checklist as one of the headers, just to the left of definitions. And that is going to take you to the personalized checklist. Now, this is the default checklist. It asks a few questions. Is it within your circle of competence, right? Is this a company in an industry that you understand and you feel qualified enough to project out what the future might look like? Is the macroeconomic environment favorable, right? If you are about to buy a healthcare stock right in the middle of major healthcare legislation, that's kind of an I don't know. Is it a high quality business, right? Don't overthink some of these. Is it a high quality business? Do they make a quality product and generate substantial profits, have high margins, they continue to grow, or is it kind of a wishy-washy, profitable 1 year, negative the next? Is there enough margin of safety with the stock, right? If you've done your intrinsic value calculation and you figure this stock is worth $100 a share and it's trading for 70, you've got 30% margin of safety. Is that adequate to you? Are the gurus buying? Now, this could be all the gurus we track. It could be a small group that you follow and believe firmly in. Are you seeing other top professionals come to the same conclusion as you in buying the same stock? Are insiders buying? Now, insider buying is perhaps one of the strongest indicators of a stock's future value, because the people that are buying are the CEO, the CFO, the in-house counsel, board members, people who know that company intimately. Now, they often receive a large percentage of their compensation as stock. So they already own a bunch of the company's stock. Now, if they're out there spending their own money to buy even more shares at current prices, that's generally a very strong sign that they think the future of the company is strong. So either the stock is trading very cheaply, or its outlook is better than the market is giving credit for, and the stock will soon rise. Is management capable and shareholder friendly, right? We talked about this briefly in a previous webinar. You may not be able to sit down with management, but you can look at some of their actions and decide if these are shareholder friendly actions. So, what are they doing with excess cash? Are they generating high returns on invested capital? Are they buying back shares when prices are low to lever up my ownership in this company? Or are they squandering cash? Are they building ridiculous spaceship-shaped headquarters? Are they sitting on $200 billion or doing nothing with? Are they getting into industries that aren't relative to their space? Is there a catalyst for the stock price to appreciate, right? And that could be anything. It could be a new product launch for the company. It could be a new boom in the sector. It could be simply enough news or press coverage of that stock for people to realize how cheap it is. But is there anything you're seeing that could shoot that stock higher? And then what is your level of confidence with this research? Do you feel good about it? Do you feel kind of iffy about it? And you'll check each of these questions anywhere from worst to best, with neutral being in the middle. And as I mentioned, you'll get a score out of 5 down at the bottom. Now that's the default checklist, but just above that is a drop-down menu, and we have some pre-formulated checklists within. These include the Phil Fisher growth companies, John Paulson's merger arbitrage checklist, right? Paulson was a very niche investor. If you're looking to do a merger arbitrage deal, and those are often referred, things like if a company is getting bought out, let's say, in theory, let's say Apple agreed to buy Netflix for $100 a share, and the stock was trading at 80. It shoots up, and now it's trading at, say, $97, $98. There's $2 there in arbitrage profit between where it's going to get acquired and where it currently trades, and that represents the risk the deal does not go through. And so there's a checklist if you're making that kind of investment. The Ben Graham net's pretty self-explanatory. Benjamin Graham, the godfather of value investing, he made a fortune back in his day by simply buying stocks trading for less than their tangible asset. So he'd find a company that's got $10 million in cash and $5 million in equipment, no debt, and the whole thing selling for like a $4 million market cap, right? It was easy back then. But occasionally you'll find those type of opportunities today, usually in the small and micro cap areas, and there's a checklist for that. The Peter Lynch fast growers, the Peter Lynch stalwarts, right? If you've read Lynch's books, you'll understand his categories of stocks, and this is going to give you a checklist for each one of those. Growth and value, the Invest Like a Guru checklist. I mentioned Charlie's book. He has a checklist within this, and he has pre-filled that in the drop-down menu. In the default, you can add others as well. So let's go through and see what these look like. And we'll kind of walk you through how to set these up yourself. So let's go to a stock again. Well, we're already on Apple's page. Let's just scroll right here to across the top of the checklist. And here we have the drop-down menu I showed you in the slide deck. Okay, so here's the default checklist with the main question, and it has your previous answers. I scored these just to give you a visual representation. You can also include any notes on the stock, whatever you're thinking with your investment hypothesis, and it will save that. So anytime in the future you come back to this security, you can go back and see, where what your thinking was at that point in time. Now, Adam asks on the checklist where it asks, are gurus buying? He said it can be dangerous or misleading. Gurus sell, and we don't know for a long time. We were holding and they sell. Yeah, so kind of off topic, Adam, but to answer your question, what Adam is talking about is the idea of buying securities blindly because other gurus are doing it. Meanwhile, they may dump it in 2 weeks and you won't know about it until the next quarter's filing, and that's definitely true. For that reason, I tend to only follow long-term gurus that have low turnover ratios, right? So you'll see some of these guys that own 2,000 stocks at a time. Their turnover, rate is 70, 80%, meaning they're dumping 70, 80% of their stocks and retrading them every year. And that's impossible to follow. However, if you find a guy who's only owns 8 securities in his entire portfolio, maybe he buys 1 or 2 new stocks a year, the odds of them dumping and getting out of that stock very quickly and you not knowing about it are much lower. But good question, Adam. So here's some of these other checklists. Let's look at the net checklist to kind of give you an idea what we're looking at there. Is the stock price less than 2/3 of its NCAV? Does it have a lot of debt? What is the cost structure here? If the revenues decline, do their costs stay the same, right? This is kind of fixed cost versus variable cost. We're looking at a large industrial company. They've got a lot of huge overhead expenses that they have to pay regardless of how much revenue comes in. Look at a more nimble company like a Google or an Apple. They have the ability to adjust those expenses based on current revenues. They have a low cash burn, or they're insider selling, or their share buybacks. How well do we understand this business? And again, as you check these boxes, it will update the score down here at the bottom. And again, these are going to save to that security in your GuruFocus profile. Now, some are longer than others, as you can see. This one here is the Peter Lynch stalwart checklist. And his definition of stalwarts, were basically stalwarts are like blue chip stocks, right? You're looking at 5 to 10% growers, something in that area, generally dividend payers, the slow and steady stocks. And so all these questions within this checklist are designed to ensure that it meets those criteria. Now, if we look at his fast growers, right, this is going to be a very different set of questions. We're looking for very different metrics for a fast growth stock than we are a stalwart. We're looking for much higher rates of revenue growth and net income growth. We're looking for, we're not looking at dividends and things like that, but we still want high quality companies. So you'll see a little bit of overlap. Is it a high quality business? Is it a simple business? What's your customer base like? But then some of the growth and valuation metrics are going to vary, obviously. Now, one thing you can do is develop your own checklists here within this. So you'll notice right here across the top, we've got a plus sign that says new checklist. And what this is going to allow you to do is basically create your own. So when we click on new checklist, you can choose, you have a couple of options. You can choose to work off a template, meaning one of the ones that are already in here, and kind of adjust those questions, or you can start completely from scratch. So some people often find it interesting. Well, I like Peter Lynch, I like his fast grower idea, but I want to change some of the things. So I'll make a new list for the name. Personal growth stocks. We'll create this list. And then from there, we have a couple of things we can do. First, you'll see the edit list here at the top. That'll let you change the name of it, whether it's public or private, etc. You can also hover over each question, and you'll have a few options. One is to delete that question. One is to move it up in your list, move it down in your list, or edit that question. So let's say you think it's our insiders buying. I don't care about insiders. I'm deleting that question. So going out of your checklist, and your scores will automatically update based on the number of questions remaining. Now, is earnings growth to date consistent? Well, it's kind of what I look for, but I really want to know, is the earnings growth sustainable? We'll change that. Update the question. And now we've changed it to reflect our own. The stock sale got a PE ratio near, at or near its growth rate. Well, this is an important one for us in this category, so we're going to move this question up. You can one at a time move the thing up until it's all the way at the top, if you like. But that's how you create your own checklist. So if you've got a certain set of parameters based on your research, your time in the markets, your experience, it's very easy to set this thing up. Now, it's going to take you a few minutes, as you've seen, but once you have them set up, as long as you're logged in, they're going to be saved in your default checklist, and all you're going to have to do is go to your drop-down menu, select that name, and boom, you're right back there at that checklist. Your research notes are saved, your previous scores are saved. That's a really nice way to kind of keep track of what you have going on. Sid, good question. He asked if you can take printouts of the checklist. I don't know that we have a printout option for them. You could obviously copy and paste these somewhere or screenshot it and print that out. But to my knowledge, there's not a print option for just the checklist. And yeah, Charmaine asked, the same checklist available for each stock? They are. The checklists are independent of the security you're looking at. So, for instance, we want to look at Bed Bath & Beyond. We'll go down here to its checklist. We're going to see the exact same thing, only there's no scores in this one because we haven't scored Bed Bath & Beyond before. But you'll notice that new checklist we just made, the personal growth stocks, that's still available. So you can apply that to any stock you search. And once you score this and add some notes, the next time you pull up Bed Bath & Beyond, you'll be able to see all that. You can obviously edit it and change it, but it's kind of nice, especially if you're using GuruFocus multiple years. You buy this stock in 2010, you come back in 15, you're up a couple 100%. You can easily go back and say, oh, here's why I bought the stock. Here's what I was thinking. Do I still feel that way? Is my hypothesis correct? Is my investment thesis correct? So it's just a nice central place to keep all that. So we got a question. I'm not sure if I can answer. Stephanie asked, with the NASDAQ at all-time high, would you be buying basically tech companies, Alibaba, Apple, etc.? It's really going to be dependent on what you think, how far you think these valuations can stretch. I saw a really interesting graphic the other day that showed, I think the last 3 years, it was FANG stocks versus the other 496 in the S&P. So, you got Facebook, Amazon, Netflix, and Google, and those were up, 80, 90, 100%. Meanwhile, the rest of the index was only up 10 or 15%. So we have a market today that is really being driven by a handful of just near monopoly companies, right? You've got Amazon, you've got Facebook, you've got Google, and these guys are basically, they're today's Standard Oil, right? They are the Rockefeller franchises of 2017. And we may eventually get into a place where we have monopoly concerns and some of these are split up. But it is always dangerous buying stocks near not all-time highs in prices, but all-time highs in or near their historical highs in valuations. So any other questions regarding either the checklists or the warning signs and how to access those. Bed Bath & Beyond, in this case, has 6 good signs, which is a lot, actually. Consistent revenue per share, high dividend yield, low price, low PE ratio, low price to book ratio, low price to sales ratio. So the valuation metrics are looking good for the stock. But on the other side, you've got margins declining, operating and gross. And that's probably largely just responsible for this stock's decline. But the nice thing is how all these features work together, right? I've been looking at the warning signs. So let's take Bed Bath & Beyond, for example, right? We saw a warning sign, your gross margins are declining, its operating margins are declining. Now, that doesn't sound great, but let's say we want to see that visually represented. So all I've done is come over here to the interactive chart. As we mentioned in the previous webinar, you do have, when available, 30 years of data built into this. So you're looking at this going back to 1992. So that's what, 25 years of stock price here, Bed Bath & Beyond. And if we want to chart those warnings, see how severe it is, we can do so right here. So we had operating margins and gross margins, right? So search for those. Gross margin percentage, right there. And the other was operating margins, right? Just so it's so easy to operate this because everything is just so searchable. Operating margin right there. So now what we have is a visual illustration, again, going back 25 years of these metrics that the warnings are telling us to be careful of, okay? So let's say you want to zoom this in, maybe just the last 10 years. You can do that here. So in the blue is our gross margin. We see it was staying around, you know, basically 40, 50%, right in this range. And we've been declining to about 37.5, as you can see today. Now, the operating margins are even worse, as they've fallen from around 15% in 12 to around 9.3% today. So roughly a 50% drop in margin. So again, you're getting the same information, but it's a more visual representation of that. Now, Charmaine asks, is there any way to put in criteria, say earnings, and find companies that have changed 20% or more? Well, sure, Charmaine, you can do all that in the all-in-one screener. If you want to find companies that say growing earnings 20% or more, all you have to do is go to the all-in-one screener. What's profitability? No, growth. Look at earnings per share growth. Let's say you want, you know, 1 year average of at least 20% or 3 year average of 20%, whatever that is, and you'll get a list of stocks that have seen that. Obviously, the more stringent you make these and the further back you push them, the smaller the number of securities that meet your criteria are going to come up. So if we look for, let's say, 10 years of 20% annual earnings per share growth, we've gone from around 7,000 companies to a total of 23. And you see that list here. So yeah, another feature, if you go to the GuruFocus YouTube channel, you can see one we did on the all-in-one screener and how to use it for back testing that covers all of that. Now, someone asked before where you could see these videos. If you go to YouTube and just search GuruFocus, you'll find the GuruFocus YouTube channel, and we have all of these previous webinars, tutorials archived there for your use. You show the same thing on Facebook. Philip, sure, we can take a look at Facebook if you'd like. I suppose you're talking about its margins. Is that what you wanted to see? We'll take a quick look at this. Now let's go to, let's just see what warnings there were on Facebook first of all. So price close to 10-year high, price to sales close to 1-year high. You know, 1-year high is not a big deal for us. 10-year high is. You go look at the price of securities. If they're increasing their sales and their revenue and their profits, I mean, you know, the price is supposed to go higher. But there's a severe warning sign, and that is asset growth is faster than revenue growth. So, you know, as you can see in the explanation here, it may mean the company is getting less efficient. On the other end, the Petrosky F score is very high. Interest coverage is comfortable. So, you know, here Facebook has 0 debt, which is fantastic. Their Petrosky F score is a 7, so very, very healthy financially, as if the debt didn't give that away. But anything you want to cover, again, can be done in the interactive chart. So Philip wanted to see just the margins on Facebook. Now, you'll notice, you know, we have 30-year data, but you get a company like Facebook that IPO'd in 2012, you get what data there is for it. And that's, you know, the stock's only existed for 5 years. So let's look at those same margins. Operating margin here. And gross margin. And so in Facebook's case, unlike we saw in Bed Bath & Beyond, these margins are actually improving, right? Their gross margin, which, you know, was 70, 73%, growing to 80, 84, 86, today it's 86.3%. The same thing with operating margins. I mean, it looks a little bit choppy because we only have, you know, the stock's only been in existence for 5 years, but right around the time they IPO'd, you know, their margins were low. Well, for a tech company, right, 10% in this case, and they have since grown those up to today's figure of 44, almost 45%. You can move any of these you want if you want to see, you know, the net margin instead. You can add that. We'll see it kind of the same thing with the net margin, right? Increasing for the last several years. Philip, is that what you want to see? Yeah, I believe we've done a session on the interactive chart previously, but this is, I mean, it's got to be one of my favorite features in this website. It's the only place I know of you can plot fundamental data and 30 years of it against these securities. There's just really nothing like it. Phenomenal tool. Okay, so we went a little bit off topic, but the main things we wanted to get covered were the warning signs, how those apply to individual stocks, how we derive those, how you can see what they are, whether they're severe or kind of iffy, the good signs, how to get an explanation, how to explore that further, how to plot it on the interactive chart so you can see it visually. Kind of a full run on the warning signs. We also covered the investment checklist. Some of you may never use these. Others of you will become a religious thing. But as I said before, it takes a little bit of time to build your checklist. But once you do, they're there permanently, and you can apply the same litmus test to any security you're looking at. Any other questions? All right, I'd like to thank everyone for joining us this webinar. As mentioned before, this will be hosted on the GuruFocus YouTube channel if you wish to view it in the future. Thank you for joining us, and we will see you on the next webinar. If you are not yet a member, you can always sign up for a free 7-day trial of our Premium Plus membership. To do so, simply go to gurufocus.com/membership. You're under no obligation to continue. You can cancel at any time. But we set this up to really let you put the website and put all these really powerful fundamental investment tools to the test and let you, put it through the paces see how it feels to you, and decide if it's something that you want to continue with. So thanks again, and we'll see you guys on the next webinar.